Hi everybody, welcome along to our 16th annual market update brought to you by the team at SMATS Group and myself, Steve Douglas. I've got your attention for the next hour as I walk through all of the issues that are affecting us in the world and hopefully give you an insight of what's going on behind the scenes, how it's going to impact you and how you can understand the chaos that's going on. This year we've entitled it From Russia with Love. Apt because obviously the war in the Ukraine has been on the march now for the last 12 months and it's impacting all sorts of things apparently. Oil prices, supply chain, and it's having a massive impact on a global sense. So I've called it that, but it's not the only issue we're facing. So we're going to cover a lot of ground today. Hope you enjoy it. Look forward to taking you on a great little journey. As always, I have to start with a disclaimer. Just a reminder that these are my personal views. All of the information is there to be for your information, for your interpretation. Please don't act upon it without seeking professional advice specific to your circumstances though. Let's get into it. As I always do with these update seminars, I'd like to start with what we said last time and see how we went overall. Now, last time, in terms of the four main food groups, we covered stock markets, currency, interest rates, and of course the Australian property market. With stock markets, I was predicting that we'd have a modest growth year. We ended up basically going flat, but we had high volatility, which was interesting. So pretty much got that right, and it's just a strange old situation, which we'll go in more detail. With the currency, I was confident we'd stay in that 70 to 75 cent range, and it pretty much did that the entire year, all the way through to October. Then it had a kick down to about 62 cents, which I thought was a crazy overreaction, and it turned out to be correct because it kicked back up over 70, and it's back settling under 70 cents at the moment. I still hold my views of 70, 75 cents. We'll talk about that a bit later, but pretty much on the mark there. With interest rates, I did say that we were going to get an interest rate lift sometime in this year, and I did say we probably wouldn't see it for 6 months, and sure enough, bang on 6 months after the seminar, the first increase came. Now, I think they've overdone the increases. We probably had too much too soon, and we'll talk about that more in detail, but it certainly had a confidence effect in the market, not necessarily a financial impact, but definitely a confidence effect, and we'll have a talk about that. Right, with the Australian property market, we've saw an unusual year. I still think the fundamentals are strong as we predicted, but we've seen a little bit of confusion in price points, largely because of those interest rate markets. But Queensland, which we predicted to be the strongest performer, led the way, did very, very nicely, as did Adelaide. And again, we'll go through in much detail. So overall, we got pretty much bang on last year, which was pretty good in a tough and a strange and unusual environment, particularly because no one saw the Ukraine war coming in November. It sort of popped up in December and through into March, and it's had chaos ever since. One of my favourite sayings for the year is I want to use that doesn't make sense. The world is getting crazier and crazier, and you might recall a couple of years ago we said that the world was going mad. It hasn't got any saner, but it's not making any sense, but it's making a lot of dollars for a lot of people. So let's see how that goes. Shifting in, before I get into talk about Russia and the effect of Ukraine, one of the big things I think that's going on in the world is the 4 I's, as I call them. And this is on a global basis and is also very impactful in Australia. So let's have a look at the 4 I's. And the first one, of course, is interest rates. So with interest rates, we've had that inevitable lift off the bottom, but for some reason, everybody is in massive panic mode about it. The reality is we are still well below our historic averages, but everybody is going crazy thinking that the end of the world is coming. No, you just had it too good for too long. So wake up and smell the coffee and realize that this is getting back to normal. We've also seen the tone of the conversation of interest rates being way too aggressive. The media in particular is pushing a message of negativity far, far beyond what it deserves. And that's having that negative effect on sentiment, confidence, and market activity. We look at inflation being the thing that's knocking everybody around the world. But I haven't believed in inflation for well over a decade. I think it's not called inflation anymore. To me, it's called greedflation. We're seeing prices kicking up. Now, some of that was inevitable from the fact that COVID saw prices go back in a lot of ways. It saw industries stop. So you're seeing a little bit of recovery of the losses of COVID in the inflation prices. But interestingly, people are paying these higher prices willingly. So it's not just that things have gone up and we can't help it. Some people are just profit taking in there. As a result, I worry about the RBA using monetary policy to chase inflation because I don't think it works anymore. That only works if it forces people's behaviours to change. And I'm not sure that we're going to see that for a number of reasons, including the fact that we're more affluent than we ever did as a general populace. The third eye to me is illusion. There was way too much misinformation, exploitations, media. It's making things impossible to predict, and that is largely fed by social media. And social media is now distorting issues, changing people's behaviour patterns, altering their thoughts and their psyche. It's making life heck of a hell for everyone on this planet. And we need to get to the bottom of it at some stage. And the last I is not quite the letter I, but it's eye-watering numbers. And that's what people don't realise. We've now got 8 billion people on the planet. We're trying to change 8 billion people's behaviour. We're trying to change the way we look at them, feed them, house them, accommodate them, move them. It's impossible with 8 billion people. And as a result, when you look at the numbers that are going up in the world, the trade volumes, the values of things, the spending power generally, I think we've gone past the point of return where I don't think it can be controlled. It's now an animal on the loose, and it just gets poked in different directions by people that benefit from that from time to time. So these 4 eyes are something that we have to come to terms with in the modern world. If we have a look at the scale of this, here's GDP. It's massive. Now the thing is, we've got a situation where they're telling us things are bad, but if you look at GDP, in 1985, 40 years ago, it was $13 trillion. In 20 years, it went from 13 to 39 trillion. By the time the global financial crisis came along, which is when we started doing these update seminars because we were worried about things, GDP in the world had grown to $61 trillion in just 6 years, from 39 to 61. If you look at the next global slowdown, it was still at 75 trillion. So the world is expanding economically all the time. And if you look at when COVID came in, at the bottom of the COVID epidemic, global GDP had already reached $85 trillion, and that's after it dipped during COVID. Now that's incredible when you consider that the whole world came to a standstill. Aviation stopped, tourism stopped, all things stopped around the world simultaneously, yet GDP barely fell a bit. And not only that, ever since COVID's now a thing of the past, look, we've already scooted up to $106 trillion of global GDP right now. And then if you look at just in 4 years' time, it's forecast to push to $131 trillion. Now this is massive momentum, massive economic power, and is accelerating because you're having so many of the poorer countries now come into wealth, so much more population moving to the middle class, and it is an unstoppable force, yet they tell us all the time how bad things are. What is bad is the distribution of the wealth. Who gets the share of what this is? That's the problem. The economic might is massive, and people should look at that in the true fullness of light and realise that what we're told isn't always what it seems. If you look at what's going on with Australia, we are 1.5% of global GDP, but we're only 0.3% of the population. So we're punching above our average, as is the USA. They amount to 24% of global GDP with just 4% of the world's population. Now that might give you some perspective as to why the USA is always trying to be the world's policeman, always trying to dictate terms about what's happening in the world, because it's trying to protect its dominance and market share. And people should not lose sight of that in all the things that are going on. If we have a look at inflation, just a classic example, here are the December 22 numbers for inflation. You can see it's starting to soften allegedly to 7.8%. Now bear in mind that the RBA's preferred range for inflation is 3 to 4%. It's a miracle that it's stayed there for all these years, but now the genie's out of the bag. But if you look at where the contribution to inflation is, it's coming from all sectors. But you can see one of them is housing, which is added 10%. Now that doesn't include established house price growth, which last year we were talking about double-digit growth everywhere in Australia. But this is only new houses, new apartments. Now, one of the things there, if the government was genuinely serious about fixing things like inflation, fixing things like housing affordability, one quick lever they've got is to remove GST from new construction. If they did that, approximately an instant 6% fall in prices would occur, but more importantly, it would encourage people into the new market, which would create new supply, take pressure off the affordability crisis, create new supply, create new housing, and stabilise the market. But the fact that they don't talk about that shows that they have not got a level of seriousness about the equation. But you can see everywhere is impacted. But it's not surprising, and this is the thing that really gets me with the RBA. If you think about food and beverages, for example, food is an issue because we've had an era of floods and fires in Australia over the last 12 to 18 months. That's had an impact on the food chain. Transport has had fuel prices go up. That has an impact on prices. All of these things could find logical reason as to why inflation has gone up, yet no one's talking about the why and is it temporary. They're just saying bring out the big stick of interest rates and thump it on the head and see what happens. That's not good economic management. That's just single force, blunt instrument, hope for the best. Last time someone hit someone in the back of the head with a blunt instrument, it didn't work very well. But this is not surprising, and I would have thought the RBA would say, let's take a sensible, progressive approach rather than a quick fix with high uptake of interest rates in a short period of time. But we'll talk about that more later. And inflation is problematic, but the thing is people can afford these prices. And some of these price increases are due to people saying, I just want to sell my goods for more. Energy is a classic case. They're turning off power plants and saying, oh, there's not much supply, we have to charge more. Turn the machine back on, please. That's all we have to do. See how we go. If you have a look at what Russia has done, is Russia going into Ukraine pushed oil prices up there for a while. And I just want to show these eye-watering numbers because they're frightening. If you think of it, when Russia went to the border with Ukraine, oil prices went up about $20 a barrel. When they went across the border, went up about $40 a barrel. Now, again, if you put that into perspective and think, okay, ideology, are they invaders? Are they this? Are they that? Or are they just manipulators? Okay? Maybe it's just because of money. Hate to say that. But if you think about it, here is the oil production every year on a per day basis. So you can see Russia produces 10 million barrels a day. If oil goes up $20 a barrel, that's worth to them about $200 million a day. $1.5 billion a week. If they get it to $40 a barrel, you can see that's worth $3 billion a week. Now, I don't know who gets all of that, but it filters around. It's going somewhere, maybe into some high-ending place. But this is frightening. Now you'd say, well, how can they put it off? How can they let that happen? Well, don't forget, if oil price goes up, it's not just Russia that benefits, it's everybody. Here is the US. It produces the most oil on the planet. A lot of people don't realize that. They always think, oh, it's Saudi or it's someone else. No, it's America. So America produces 19,000 barrels a day, 19 million barrels a day. That's worth $2.5 billion a week of extra money. It doesn't cost any more to produce it, you just sell it for more. And if it's $40, that's $5 billion a week extra revenue. Now this is where the eye-watering numbers affect us in so many ways. If you can move a price for a short period of time on a high volume item like oil, someone has changed the distribution of wealth for that period. That $19 billion is coming from somewhere, and that's shared between just the top 10 oil producers of the world. $19 billion a week, more there instead of there. Now guess where it came from? You and I. Every time we filled up that Bowser. I think at the height in America they said Do your bit for Ukraine. Pay it at the bowser. You're fighting Russia. That's your way. No, you're putting money in someone's pocket. They didn't need to lift oil prices, but oh well, we might as well benefit accidentally if it happens. So it makes you a bit concerning there. But those numbers are indeed eye-watering. If you have a look at the oil price, here we go, back in 2022, it was sitting around that $70 to $60, $80 a barrel in value. Move your troops up to 120 so quickly. Now again, this is just factual, but trying to remember, it's March when I'm doing this video. Is the war over in Ukraine? Apparently not. But somehow the oil price has come back to $76 a barrel. So if it went up during a war and the war's not over, how can it be down? And again, look at that temporary shift. Now that you could argue that we're being looked after by good governance and they're helping us and doing their thing to keep it, I'm not so convinced. This is just shifting of a commodity. Someone benefited pretty significantly. If you look at the Australian average fuel price at the pump, you can see it roughly correlates with that graph, but we're still quite high even though oil price has gone back low. And again, if you look at the stats, just for reference, when oil's at $80 a barrel, it's cost roughly 50 US cents a litre. Just out of reference. None of us ever check these things. You know, it going up to 120 adds 25 cents a litre base cost. It doesn't push everything else up, that's stayed the same. But it pushes our price up usually by more. Interestingly, in Australia, the government, Liberal at the time, said let's help everybody out from this war apparition price lift, and they took the fuel excise to half during that period from March to September of 2022. But strangely enough, it wasn't enough to suppress the price growth. Now, there was watchdogs checking that there was no gouging. I'm not sure how much checking they did, but it's still high. And when you consider that oil is back to normal, yet when I turn on the news, no one tells me that. When it goes up, it's the first story that they lead with. When it goes down, no need to mention it. Let's just keep going. And as long as we don't complain too much of the bowser, everything's fine. If you have a look, you know, apparently around about April or so, 22, there was a little yacht in the Mediterranean being built. And I think it was for someone living in Moscow, I'm not sure, but it was costing $700 million. And that doesn't include the helicopters to sit on the 2 heliports. But maybe I needed to generate a little bit of extra cash flow to help do that. Pure coincidence, probably got nothing to do with it, but this is the world we live in. It's all shifting, it's all emerging, it's all confusing. And that's our little Russian present. But if you look at the current state of play, this is why it's getting so hard. You know, confusion and misdirection are now ever present in everything we do. You know, it's hard to know what's going on. Things that should happen don't happen. Things that happen, you know, just are crazy. But, you know, I think that's a large to do with social media because that's our information source. And it's a chicken and egg environment. Are we, you know, responding to the news or is the news responding to us? I don't know. It could be both. But certainly it's influencing direction, it's influencing behavior. And that's the thing. Now, that is not necessarily a bad thing because it can make an overnight millionaire out of Justin Bieber. But for most of us, we're not going to get that sort of economic benefit. We're just going to be part of the machine, and we need to think about how we handle social media. You know, one of the reasons for that is because we've moved into the era of digitization and we're just entering the era of artificial intelligence. Now, a lot of people don't realize the full impact of AI, but what it does is it lets them analyze that information far quicker than ever before. So before, if I had data, I had to have a whole bunch of people in a room and, you know, process it and analyze it and then get a report and then say, hey, what should we do with this? And it could take months, years, weeks. The census used to take 2 years to come out once they did it. Now it comes out in months. But AI is going to make that days, weeks, minutes. And that's what technology does. As that information becomes digitized, its ability to be analyzed instantly and therefore shift direction, alter path, disseminate information to move is rapidly changing. And that's the big gamble we've got moving into this age of AI, is what are we going to do with it and how's it going to help us or hurt us? That's the big question. As a result, the old rules no longer apply. Anything you think you knew about anything of the yesterday, you're done. Forget about that. It's influencing, it might influence your character, but it isn't going to influence the world anymore. So you have to start thinking more like today. It's a bit like I always remember people say, oh, how are the young people ever going to afford a house? Easily. They have parents with deposit, they have higher paid jobs. That's how they're going to do it. They're going to struggle, absolutely. But we always struggled right from the very first day to today. It's always been a struggle to buy a house. It should be a struggle to buy a house. It's a house. It's meant to be hard. But no, things are getting easier because you've got methods. Doesn't make it any better, but it certainly is easier. So learn what's going on in this new thinking environment, because there's lots going on. And I think one of the biggest problems that I have in the current age is good government is absent, completely absent. In fact, I think they're participants now. We can't rely on it. And if you look at the quality of leadership around the world, it's not getting any better, which is tragic. But again, chicken and egg. Do we deserve these leaders, or did we create these leaders to give us what we deserve? I'm not so sure. It's one or the other, up to you to decide. But someone has to step in and say, hey, turn that power plant on. Stop doing that. Hey, stop manipulating the stock market. Hey, do that with fairness. And again, get hold of the numbers, because what government is spending on things now is out of control. Billions and billions of dollars on all sorts of things, because it sounds good politically to announce, hey, we're spending this billion on that, and no one's saying, what did we get for it? That's the key. Not how much we spent, what did we get for it? And we have to come back as a society into that box. Social media was meant to help us with that. I'm not sure, because there's players behind the scene where we liberalised ourselves and then the power got control of it and turned it against us, just when we thought it was the right thing. If we have a look at that, I'm not here to get you to protest. I'm not here to get you to get up in arms and rebel and say, let's go down with placards. Quite the opposite. I don't think there's any reason to concern about the way the world works. It's happening, it's going on, but we're generally getting better. What is happening is the people that need to be looked after aren't getting looked after as well as. There's a bit of a facade, but it's just the reality. But again, I don't think things have changed that much from when I was young. That used to happen there, it just wasn't as obvious or intent. But you have to realise that you are responsible for yourself. Don't worry about what's going on, but what you do need is a much, much higher level of awareness as to what's going on. Hopefully something like this event is going to give you some things to think about. I'm not here to tell you everything. I'm here to poke you in the brain and make you think about what's going on. The world is going to change. The world is going to evolve. The world is going to be abused. You're going to have confusing points. So find a way to get some level of sensible awareness, not necessary through social media, but through watching the actual interviews of people, reading, analysing, looking at real numbers that make a difference, and not getting distracted in the noise. So all in all, the world is just how it's been for the last few years. Crazy as, but it's our world. We made it. We have to live in it. Let's not worry about it too much. If we have a look at the key issues that we're here to talk about, and the first one, as always, is the stock markets. And probably with the stock market, what we do have is the US market had a little bit of a comeback to reality year. We saw last year incredible amount of overvalued US stocks, but no one seemed to care. And so I didn't have any reason to worry about them kicking back, because everybody seemed happy. But we saw a correction of up to 20-30% on some stocks in the US, even in the top end corporations. That comes as no surprise to me, because they were massively overvalued in the first place. So to see them coming back now to these current levels, I don't have any concern. That's where they should have been. In fact, for many, I still think they're overvalued if you look at the number crunching. But everybody's saying this is the bottom. Now, as a result, again, confusion reigns supreme. Anything could happen either way. What that does mean is that are we in a position where confidence is flat, or are we seeing a period of profit taking? Now, when something goes up, someone's making money. When it goes down, someone's usually seeking opportunity to buy. So to me, it's a hard one to call right now because we're just starting to see the US market start to reignite. But as I say that, just last week, the Silicon Valley Bank collapsed and sends the frenzy and the rumor mill into overdrive once again. Again, misinformation. One bank could be the start of many, could be just an apparition, could be just a badly run business that shouldn't have been doing what it was doing. But watch the rumor mill and the misinformation go out of control over what could potentially happen as a result. That's going to be interesting. Now, I still remain focused on value. I still think that's the only way to invest, even in the modern, crazy, manipulated, and strange world we live in. Value still is the most real thing you can do. Now, crunch numbers sensibly, good PEs, good profit, good dividends, etc. And hence why I've always been heavily focused on making sure that we have dividends from companies you invest in if you're going on the stocks. If you're going growth only, you're hoping things go well. But if you get a dividend, at least you've got a backup plan, that you've got some money on the table to buy your groceries. You don't have to worry too much. It helps you sleep at night. And believe you me, when you have volatility, you need a sleeping pill. And that dividend is that. Volatility is strong as ever in the market. Even though it's been quite flat, it's still been a highly volatile year, and I can't see that changing for all the reasons that I mentioned previously. We're living in that different world, that digitized world, where people are doing what they want and they spin the story on the mass for us to just mind our own business. We're more interested in things that have no relevance on our life than the money matters that are ruling our superannuation and our investments and our livelihoods. And if you look at why I'm saying that, here is the stock markets over the last 12 months, since we did the last seminar, and you can see that we basically started a base of 0, and over on the other side, we're finishing at a base of 0 pretty much. So the markets have literally done nothing. Now, we predicted that they would do around about mid-5s, and you can see here when we did our seminars, usually we would do our seminars in October, and sure enough, we would be at about mid-5s. But we had that big drop in October, which is normal. Happens every year. I'm not sure why, but they're consistent. But you can see the FTSE has led the way. It's up near on 15% year on year, which is incredible when you think that apparently the UK is a basket case right now. But it's the strongest market. Australia comes in second, overall just on 5-10% growth year on year because there's value and more real. And then the Dow Jones, basically nothing. But if you look at this, it's been as high as 15s, it's been as low as -12s. In that volatility, someone is making a lot of money. And that's the thing. It's hard to know what to go to. And it's one of the reasons I'm not a big fan of index funds, because you can see over the year they're telling me I earned not much. But someone made a lot of money in those highs and lows and those peaks and troughs. Just usually isn't us. So think about what you're buying. Don't follow the indexes as much as you should. Follow individual stocks that are good value, a good company with a good dividend at a good price. They're the things that matter the most. This volatility is here for good because no one is checking on it. No one is policing it. And that's incredible to me because we live in a digitized age. The government knows instantly who made or lost money every day on the stock market because it's all digitized information. But no one ever gets brought up and asked and checked, not publicly at least. If we have a look at the reality of it, I'm curious, does anyone actually check numbers anymore? Because they're very, very frightening. If you look at it, here are the companies we track every year. So this is not saying you should buy these. This is not saying anything. This is just indicative. We've been tracking these companies for all of the update seminars we've done because they're large, they're significant, and they're good barometers of what's going on. Now, if you have a look here, BHP to start with, sad year, it was down 11.7. Now, I'm benchmarking the same as we do every year, which is basically the 9th of September to the 9th of September. And there's BHP down 11.7%. So one would think that if you're down 11.7%, your profit mustn't have been very good that year. But if we look at the profit, it went from $11 billion after tax to $30 billion. Now, I'm not sure about you, but my logic says that if my profit has gone up 3 times, my share price should have gone up quite considerably. But not in the modern world, apparently. That seems to be a bad thing. Goes up profit, goes down value. Makes no sense. If you look at HSBC, its profit went from 4 to 12. Its stock price did do very well. But last year it went up more, even though the profit went down. Doesn't figure. If you look at Bank of America, it brought in a $30 million profit, almost double the year before, and it came in with a 15% drop. Where last year it underperformed the previous year's profit and it didn't do so, it went up 60%. And this thing, these numbers are strange. Okay? Microsoft, classic case, its profit up to $72 billion. Billion, that's a lot of money, but its value went down 11% year on year. Now that could be a value buy, it could be the start of a trend downwards, but it's strange that when you're making that much profit and increasing year on year, how does your share price not demonstrate and reflect that? And this is what I'm saying, the confusion in the world, the misinformation, the manipulation is becoming stronger and stronger and stronger. And again, don't panic, don't sit on the sidelines, don't protest, just understand that things are going to be weird and try and take advantage of them in that regard. If you look at the 3 key indexes, there's the down, officially down 7.7. The Aussie was down 6.8 and the FTSE up 4.8 in our same cycle periods. Now that's since recovered that, kicked back up, all quite nice, but it just shows indication. Now again, nothing really to warrant those falls. Profitability was strong, COVID was over, everything was good, but the market went down. You would have thought in 21, 20 that we would have had big falls through to COVID, but apparently not. And that's why no one can predict what's going to happen. No one knows. But if you buy a good company at a good price, at a good dividend, you're better off than you would be if you're just punting at the wind. My first prediction of this year's update for the stock markets is I think the US market's going to have a pretty good year. It came off last year for no real reason, good strong profits, and it's still a fall. I think they've repositioned the market, took some profits, ready to buy back at the lower prices and push it ever high to make even more money for the larger organisations. The Australian market I think is still terrific value and I think it's going to have a good year, 5 to 10%. And I think the FTSE is just going to kick on keeping on because it's a decent market, it's fairly controlled. I think it's going to have a pretty good year. So overall the stock markets should do pretty well because we're out of COVID, the world's in a fairly sensible place, oil is back normal, let's see what goes. But I'm sure they'll throw a couple of hand grenades over the fence somewhere and see what happens and cause a bit of mischief. If we look at currencies now you can see the currency, as I mentioned, stayed in my preferred recommended band of 70 to 75 cents for most of the year, except for this latter part where it dropped down to 62 cents on the back of negative economic activity. Now that I think was a massive overcorrection. There wasn't really any fundamental reason for that other than speculation, concern and market shift. But as a result, it recovered quickly to 71 cents again towards the end of February. Now that has now come back off to 62 cents. Now I think this is still, 64 cents. I think this is still an overcorrection because one thing looming in the US is the debt ceiling, which will start to come into play around about August to October. The US has to get more and more debt. Its deficits are bigger and bigger with no sign of reduction. So I cannot see the justification in a sub 70 cents. Again, just my opinion, but I'm going to stay on track and say 70 to 75 cents is still my natural range. I'm not deviating. I haven't deviated for many, many years now, and the market is sort of agreeing with me. But again, you're seeing that volatility, you're seeing that speculation, you're seeing that manipulation in everything, including currencies. So I'm going to say prediction number 2 on currency, 70, 75 cents. If you're looking to change US to Aussie, it's a pretty good time to do that. And the Singapore dollar, unbelievably good value. You know, the FTSE, there's some good value all around on the Australian dollar. Let's see how that goes. Moving into interest rates. Well, you can see here, we had a massive uplift in interest rates, massive uplift. Again, most people didn't think that was coming because the RBA had said officially, we don't think we'll put interest rates up for a couple of years. But of course, what people say and what people do these days, not only is it not the same, but they're not held accountable for changing their mind. And they don't have to worry about giving warning or saying, oh, I'm sorry, we didn't think we would have to do it, so we'll do it slower than expected because it was a surprise. No, it's let's get out that blunt instrument and smack everybody as they can. I will take credit for that prediction. We did say that rates would rise. We did say they wouldn't be for 6 months, and that was on the mark. But there's no way I would have thought that they would raise them this fast and this aggressively. Traditionally in Australia, when we see interest rate rises, we only see 0.25% increments. But you can see here, once they started getting into the mood, we saw 0.5% increments in consecutive months. That to me was negligent. I don't think they should have done that. Now, if you want some sort of bearing of reference for that, history is a great indicator of the future. If you look in the past, every time the RBA has put rates up aggressively and quickly, they've had to hit the reverse and bring them back down just as quick. Now, to me, that is bad management. They'd be far better to do rise, pause, rise, pause, rise, pause, and see the impact of behaviour rather than go rise, 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 oops, we went too far. That's just bad strategy. But for some reason, they don't have this chart, apparently at the RBA, to look at it as a reference point. Someone should perhaps drop it onto the desk at the next meeting. As a result, I think they've gone too fast, too soon. I think we are at the end of the rate rises, so we shouldn't be seeing too many more, 1, maybe 2, logically. But bear in mind, I think we've seen 2 or 3 too many already. But what has happened is we've seen a mental reset. This is still super cheap by Australian standards at the 3.6%. You can see it was a long time ago before we had never even been in this sort of low rate environment. But now that we've enjoyed all of these years with this lovely low interest rate, that has become the new norm. And we've reset our minds to say that's what it should be. So people aren't complaining that rates have gone up. They're complaining that why aren't they zero like they were a year ago? That's not logical. That was too low for too long. So it was inevitable they'd go up, but no one was paying attention. I think too fast, we'll see a correction. And of course, the reason that they say they're doing this is to catch inflation. But I don't think that this is going to work because it's an outdated tool, that isn't going to work anymore. People aren't having the same level of lack of savings, a lack of spending ability that interest rates would bring. And they're all saying there's going to be an interest rate cliff, people are coming out of fixed and will fall off. But anyone who got a loan with cheap interest rates that they fixed, was assessed at these levels for their loan approval. So they're not coming out into unaffordability levels, but they are going to come out into discipline issues. They're going to have got used to spending these interest rate savings, and they're going to have to change their behaviour, which I think is going to be extremely hard to do. But it's an odd world. As recently as 12, 18 months ago when we did the last update, we were begging people to fix their interest rates. And people said, they'll go lower. Well, I'm not sure, but it's pretty hard to go much lower than 0.1%, but somehow they thought they would, okay? And so a lot of people were waiting for it to get even less than it was and then forgot to fix on the way up. But now it's probably too late to go and do so. Now, Australia is not an orphan. The rest of the world is also putting rates up, as is the US. And again, too fast, too aggressive, too soon. So don't be surprised if they too have to hit reverse and start cooling sometime soon. Now, allegedly, it's inflation that we're chasing. And you can see there, inflation has moved into that 8% band that we talked about earlier. But again, only just recently has that happened. So to me, I'm not sure why they needed to be so aggressive when it's only a recent phenomena, especially when it's justifiably found in the fact that we had fires and floods, in the fact that we've had China supply issues, in the fact that Ukraine was invaded. You know, all of these are logical reasons. To me, you only need to chase something if you don't know why it occurred. You know, that's the thing. We know why this occurred. Is this old-fashioned method going to change it? No. And one of the reasons I believe that is because people are driving inflation by their behaviour. They're spending the money. What people spend money on now is shocking to me at times. It's surprising. You know, what we pay for stuff is incredible. And we don't go and necessarily look for the deals. You know, people are paying brand top money and it's just got out of hand. Water, if I go to the service station, is $3 to $5 a bottle. You know, it's more than oil, yet we all complained about oil. You know, potato chips, which is my favourite one, $4 plus for a bag of potato chips that has probably 2 potatoes in it. Yet, because it's my favourite brand, that's what they're paying. I look for everything on sale. It's the same potato. It doesn't make any difference. But we are now massive consumers and we are paying what the supplier is asking, and therefore he's saying, well, if you're willing to pay, I'm willing to charge. So the only way you can slow down inflation is for consumers to say, I don't want that. Now, in the old days, in the 90s, you could use interest rates as a tool because it meant people who didn't have much savings had even less money available, so they had to change their behaviours. But in the modern age, particularly in Australia, people have savings, so they will not alter their behaviour until their savings have gone. So it could take years before this sort of action is going to reap results. And hence why we should have been working on our supply issues, accepting the inevitable and getting people to offer better value and consumers to be more shrewd on their acquisitions. One of the reasons I say that is if you look at our wealth profile as Australians, it's far, far better than it ever was. And even though with house prices coming off, it has come down a bit, but it's still significant and we have capacity. And this is particularly true in the East Coast in New South Wales, where people are realising profits now in the property market. Even with a reduction in price, it's still massively above what they originally paid, and now have significant cash wealth to spend as they wish at whatever price is being offered. You know, as a result, with that savings, monetary policy, I think, has gone into the oblivious bucket. It's not going to work. The RBA needs to wake up and understand that and start working with government to fix the issue of supply, to fix the issue of behaviour, and then maybe we can get it back in check. But the problem there is that the government is one of the biggest drivers of inflation because they are the most generous and ridiculous employer in the country right now. Things like NDIS, you know, government schemes, you know, at home for the aged. They are paying extremely high amounts of remuneration, you know, for highways, for contract work. The government needs to pull its head in. Yes, do the work, do the infrastructure, do the spending, do the support programs, but you don't have to be the most generous payer in the room. You know, create the foundations of value and sensibility so that every part of the economy is not, you know, forced into a corner, you know, based on this high standard the government is pushing to. Part of that is because a lot of it's being driven federally, and if it's a Sydney wage being put in Hobart, that makes a big, big difference. But the government needs to get sensible on how it spends its money and be less generous and more demanding on the way it does it. And we as consumers need to work it. If we look at what interest rates look like now, and I've put up in red, sorry to torment you, what they were just over a year ago, back in November 21. And here we are, today's rate on P&I is 4.74 for an owner-occupier. It was 2.29 in November 21. Again, fixed rates, 5, 5, 5. A year or so ago, 2s. But people thought that was expensive and didn't fix. So if you didn't fix, you certainly are not getting the benefit. But to be frank, these are traditional levels of interest rates. In fact, not only are they traditional, they're on the low side of our traditional levels. So as a result, we should not be complaining as much as we are, but let's face it, as human beings, it's our nature to want that, not this. Now, we can't turn back the clock. If you think about it, to get interest rates to that level, we had to have a global pandemic. So if you want interest rates back at those levels, maybe we should go or lock ourselves back up. So I'm pretty sure that if I gave you the choice of this interest rate or that one, this one with freedom and prosperity, that one locked in your house for another 6 months, I'm pretty sure that all of a sudden 4.74 doesn't look so bad. Now the thing is, the fixed rates now are higher than the variable. So it's probably the wrong time to fix. Up to you what you think they're going to go to. But if we are at the top end of that cycle with only a couple of more, you can see here a 3-year rate is 5.49 compared to 4.7. So in there is 3.25% rate rises potential. Okay? If we do that and fix now, and the RBA potentially doesn't increase rates, you'll be paying more than you need to, and you'll regret it. So you're probably at the point where we might want to see what happens for a while. You've got 3 potential rate rises, which could take anywhere from 3 months to 6 months to maybe even a year if they do eventuate. But try and hold fast, try and be efficient. Rents have gone up a bit to help, and see how it goes. Now my prediction for interest rates is I do believe that we're pretty close to the end of the rate rises. Maybe another quarter is theoretically justifiable, but I think we went too high too far. I think we're going to plateau, and I think we might even have to knock them down a little bit depending on how it goes. So don't panic, don't throw the baby out with the bathwater, but make sure your behaviour and your patterns and your spending is as best under control as it can be, and look for fixed rates when they become more aligned with the variable, because they'll change pretty quickly as the market sees rate rises stopping and rate reductions becoming more likely. So the worst theoretically should be behind us. We'll see, and I hope I'm right, because if I'm not, it's going to be a lot of pain for all of us. Moving into the property market, I always start with the world's most livable index, and usually I only do the top 10, okay? But this year you can see I've put quite a few here. I think I've got about 15 on the list, and the reason is Australia got kicked out of the top 10 with just Melbourne sneaking in as equal 10th this year. Now Melbourne traditionally has always been the world's most livable city. It got nudged from 1 to 2, but during COVID it went to 9, which, let's face it, that's a miracle because it was on lockdown more than any other place in the world. And as a result, this year has gone to 10. Now, what COVID has done, as you can see, it's changed the index remarkably. The number 1 place, Vienna, was 12th last year, now first. Now, Vienna has always been in that top 1-2, fighting it with Melbourne. So no surprise to see it come back. And in truth, I think Melbourne will have a similar rebound coming back into that top 10 higher up next year, as COVID is a thing of the past. And it's incredible to think here in March 23 that COVID is pretty much done and dusted. But A year ago, I moved back to Perth and I had to go through quarantine rules to come back here. You know, we were still wearing masks. We still had all sorts of issues. My favourite football team was in turmoil because they had half their players had COVID. The world was a mess. And all of a sudden, just 12 months later, it's all good, back to normal. But you can see here, a lot of the ones that have jumped into that top 10, 15th, 18th, 16th, 39 for Frankfurt. Frankfurt has gone from 39th to 7th most livable. And Australia, poor old Sydney, went from 11th to 13th. Brisbane, 10th to 27th. Adelaide, 3rd to 30th. Not sure why. And Perth, 6th to 32nd. But just as a reference point, last year Auckland was number 1. This year it dropped to 34. So you can see just that little bit of inconvenience with COVID has had a massive impact in this ranking. But I do expect these cities that have been consistent top 10 performers to come back in, and particularly when it's so wonderful in Australia. And we're now allegedly COVID neutral, managed, whatever you want to call it, but it's not an issue anywhere. So it'll be interesting to see what happens with this next year, whether Australia regains its natural status or whether we've reshuffled the deck and it stays like that for a long time. This used to be, as I'd always point out, the best advertising in the world for people to move to Australia. So have we lost our advertising power as a result? That's going to be very interesting for me looking at next year's index and seeing if Australia regained its position. Moving forward, what that has meant as COVID is that we've seen a big population slowdown. We traditionally saw population growth at 1.6, 1.6, 1.4. That was leading the world. There's not many places in the world that were getting population growth rates to those levels. Roughly half net births, roughly half migration. So massive economic value in doing that, massive underpinning to the property markets, etc. But you can see during COVID, the December 2020, the first big year of COVID, we didn't go to the negative that they were expecting. We still grew at 0.5%, which was basically all net births. Okay? And in 21, we also came in at 0.5% growth, 128,000 more Australians, basically all of them in diapers. That's just how it is. But it's still quite strong numbers as we've now passed that 25 million mark and cruising towards 26. But this has always been the thing that I've said separates Australia, our consistent migration, our consistent population growth of affluent, happy, well-employed, well-paid, affluent people is our secret economic weapon. So to have this return back to normal is critical. And if we have a look at the reality, it is already occurring. Okay? So we're going to have this lag effect on the numbers because they do take quite a while to compile because apparently they're not digitized yet. But you can see here, during COVID, we had a big dip in our incoming migration, net overseas migration, but birth stayed quite consistent. And as a result, we actually went negative migration, negative population growth for a brief period. But interestingly, the government had forecast that our population growth would drop to 0.2. It did achieve that in the first year of 2021, but it predicted a 0.4% population growth in 21-22, and that actually came in at 1.1. So that was a significant uplift. They were expecting minus net overseas migration, 21.6, and that actually came in at 170. Now this is important because one of the key reasons for that minus was a huge student population left, a huge student population, primarily to China. And what happened, of course, is the universities all went online. Now, it really impacted Melbourne's property market because it's full of apartments that are small that students were living in. So it really had a negative impact on the vacancy, the rentals, etc. But interestingly, I just got back into the airport the other day from India on the day that China announced you were not allowed to study online anymore. And the airport was chock-a-block full of Chinese students all flooding back in to miss the deadlines. And so you've seen a re-influx of that student population. So you can expect this net overseas migration to have a hyper kick as all of those students have come back to finish their degrees, finish their studies and start things back to COVID normal, life normal, Australia as the best place for them to hang out and see what happens. So expect that to have a very, very positive impact, particularly in Melbourne, but also in Sydney as that changes. But this migration is critical because we've been having issues with supply, and if you've got demand and supply problems at the same time, there's a lot of pressure in the market. So having soft demand helped us, but we still saw there was massive supply issues. If we have a look at the property market, it's definitely interesting times because probably the biggest influence in the market was the fact that interest rates going up took all of the steam out of the market. So you had the fact that interest rates going up, and more particularly the reporting of what that meant. Instead of saying, hey, we knew this was going to happen eventually, it started, don't worry, that was going to go. It was like, oh my gosh, why are they putting rates up? They said they wouldn't. Negative, negative, the world will fall. But this was causing paralysis. Because it's so negative, everybody thought, I'll wait and see. I'll wait and see. Why? Because of the fact that you have a situation where emotions become overriding. Now, emotions do two things, fear and greed, right? So the fear is, oh, I better not buy because prices will go down. And greed, I'll wait till it's cheaper. Now, the problem is we have still very strong supply-demand issues, and so the property that we want to buy isn't coming cheaper for two reasons. Number one, there's still a huge amount of people that want to buy it, and number two, the people that are selling it say, I won't sell at that price. So what that means is supply contracts even further, and therefore in the high-end markets of owner-occupied stuff, we haven't seen the level of falls that the general market has. But the statistics report what has been transacted. And if the bigger properties aren't being transacted, we can't see the number. As a result, there's a big reality check. You want to go buy a bargain, you go looking for the property you've been looking for at a bargain, and there is no bargains to be had in that sector. So all of a sudden you go, wow, I better pay that price. We're seeing very high results in auctions. We're seeing high turnovers. We're seeing everything going in favour still of the seller in the main. Okay, we're not getting the top line prices we were, but the good stuff is still selling at very, very strong prices. And primarily because of the fact that supply is soft. Now with interest rates going up, that's going to be an interesting challenge because one of the reasons I could say I'll wait and see what happens before as a seller was because interest rates were so cheap, my holding cost was low. But what we are going to see over the next 6, 12, 18 months is people that were thinking about selling with a reasonable mortgage on their property are going to be far more motivated to sell because the cost of retention has just gone up from 2s and 3% to 5s and 6s. So that's going to be an interesting factor. Hopefully we'll bring more supply in, more willingness to transact, and we'll see what goes on. The issue though we have is that new build is problematic. It's still taking a long time to bring stock on, a long time for approvals, not enough stock to keep pace with the now new influx of migration. We just have supply problems and demand is strong and rising. So if you have soft supply and high demand, logic tells you prices will hold or rise. Simple as that. Now, one of the issues I find is governments of both sides are not addressing the supply issue. Things like I mentioned earlier with inflation. If you're serious about improving affordability, take GST off new constructed dwellings, apartments, new builds. There's no need for it to be there because the government makes the money on stamp duty already. And with prices now far, far higher than they ever were, they're making a small fortune. 6% stamp duty, 6% GST, 12% on every price is going to the state government. Stop it. Take one or the other, increase supply, reduce pressure, allow the population to be housed. But they are not addressing it because it doesn't suit their financial cause. They want as much money coming in as possible. They don't want to fix problems. What I see coming along is very, very quickly, everybody's going to lose, patience and say, look, I've been waiting for price drops. I've been waiting for interest rates to slow. It's happened. I need somewhere to live. They have to go buy it. You can only put it off for so much longer. Now, where you can see that that's going to be forced upon many people is the rental market is in absolutely perilous state for tenants. If you do not own, your rent's going up 10, 15% in some cases. So guess what? You're going to be highly motivated to keep going, because now there's a real issue, probably for the first time in Australia's history, that when your lease comes up, you may not get an automatic renewal. Before, always, oh yeah, you've been a great tenant, you've been here for a couple of years, modest rent rise, stay on, she'll be right. Now, I'm going to look at you and I'm going to go, my agent just told me I can get $200 more from somebody else. You're a nice person, but I'm taking the $200. Now that's going to be a big issue, because people are being taken out of their comfort zone and they're going to have to act. And one of the ways they're going to do it is through ownership, if they can. But at a time when interest rates are higher, but still at the low range. There's going to be a lot of mental stress in Australia, but it's always been there. That's why it's under the NDIS, apparently, paid for by the government. But this to me means we are moments away from the next kick in the property market. And don't be surprised if we have an above average year. But to me, probably the biggest elephant in the room when it comes to the property market is stamp duty and land tax. Stamp duty, as I mentioned, in regards to the double dip on new property. Land tax is becoming a major problem, particularly in New South Wales, where they're charging foreigners, including permanent residents, so not Australian citizens, a 4% of the market or the land value of the property each year. It's tens, if not hundreds of thousands of dollars some people are being charged because they've snuck the values up on paper. Now, most Australians don't know about land tax or care about land tax because it's not payable on your family home. But if you are an investor, if you are providing accommodation for a tenant, you are likely to be paying it because the values have been snuck up. And it's going to become a bigger and bigger and bigger issue. But because the majority of the people are owner-occupiers, it's literally an impossible argument to win at government level, because they're saying, you're a landlord, you can afford it, you collect rent. But I have clients that literally pay as much in land tax as they collect in rent, never mind the other expenses. It's getting out of control. Now, we'll have to see if anyone cares enough to make the changes necessary to do that, but we'll see. Stamp duty, similarly, they're getting that 5-6% stamp duty, but they're getting it on a much, much higher price today than that property was transacted for previously. Why? Why shouldn't it just be a flat $20,000 rather than, oh, we got $20,000 last time, but now the property's doubled, we get $40,000, $60,000. In some cases, in Sydney, you're buying a $3 million property, the stamp duty to transfer is near on $200,000. It's outrageous. It doesn't need to be there. How much does it cost to do that, to move that property? The services, they're already there in those areas. Nothing makes sense, but this is going to be the biggest battleground of property investment over the next 5 years, mark my words. If we look at where everywhere is on the market, we've got a situation where all the markets are pretty much exactly where they were last year. They were doing well, as we thought they would, and then with the aggressive interest rate rises from the RBA, it's all in paralysis. So I'm going to leave everything unchanged from last year because of interest rate paralysis. But mark my words, once people realise that we are still at the low end of the range of interest rates and that they need a property and it's not getting cheaper, that paralysis will be lifted and the market activity will be strong, particularly in those high population growth areas, in Queensland and Victoria as those students come back. Moving on, let's have a look at some of the numbers. And you can see here, the September quarter was absolutely atrocious across the property markets in Australia. Now, that's not surprising because the interest rates were being lifted aggressively, okay? And they've still gone up even more. So it's not surprising to see everything in red. But if we look at year on year, it's not quite bad. And the reason is we had a very, very strong growth rate in the year prior. You can see, Brisbane came in at 23% to June 22. We've had Sydney doing 19, 15 the year before. So it's not surprising when we've had too much growth to give a little bit back. We're still well ahead of the trend. But okay, it's nerve-wracking if you've bought recently at these numbers. But if you've bought quality, you're not necessarily seeing those negative numbers. These are transactions, and I say a lot of the good stuff is not transacting. And if it is, it's not transacting at much less than before. So I don't think this is a general depiction of the market at the moment, because you've got buyer paralysis and you've got seller paralysis too. So I don't think we're going to see numbers of relevance through the September, December period. We're only going to see the March, June next year and see what happens. But you can see not a good year for the quarter, not too bad year on year, but overall, odd. If we have a look at the numbers across the thing from the REIA, the September quarter again, not good. But 1 year, Sydney was only down 2.8%. Melbourne fell 9%, largely because of that exodus of students, which is now coming back. And you'll see from the vacancy, it was over vacant in that market. But Brisbane, 13.8 year on year. Perth, 3.7 year on year, after giving back 2.8 recently. Adelaide, 18.8%. That's fantastic. But, not surprising these two are there. And again, if you look at the numbers we're doing over the years, Sydney is still 53% above the national average. Now, I think that's a little bit concerning, but where it's significant is this is the first time in the history of Australia that someone can sell out as a normal person in a market like Sydney, okay? And they can sell their home, and they can use the proceeds from the sale to buy a replacement home in Brisbane, in Melbourne, in the Central Coast, in another suburb in Sydney, in a smaller apartment rather than a big house, in a downsizer. They can sell their home at above the average, national, buy at the average in another state or in another style, be debt-free, renovate, and still have significant capital left over in cash. That has never happened in the history of the Australian market before. So this realisation of significant uplift of Sydney and then distribution into other suburbs, other states, is the thing that is changing the property market more than any other thing, and the thing that most people have not yet figured out. Now that's going to have a ripple effect into Brisbane, where you can see that's why its prices have kicked up, because people have sold out of Sydney, moved to Brisbane, bought an amazing house, often twice as good as their previous one, for half the price, and still got cash left over. This is a change of behaviour. This is a change of circumstance. This is a change of market. And mark my words, this is a turning point in the Australian property market generally, that benefits from that cash out and redistribution, and it will filter into Adelaide, as you see. It will filter to Perth. It's already got to Hobart. It's going to happen more and more consistently, because Sydney is getting more and more congested, more and more overcrowded, more and more expensive, and these other places offer more and more lifestyle. So I can cash out, go live like a king in a castle rather than in a dungeon in Sydney. That's going to be a big influencer. If you have a look at the overall market from a rental point of view, and this to me is the biggest decider of risk, okay? Vacancy is the single thing that determines how much risk is in the market. And you can see here, if we look at the vacancy rates, Sydney, the Australian average 1.7, Sydney 1.5. Melbourne is high at 3.6 because that student population had left during COVID. But have a look. Already just in this quarter, and this is to September 22, before the rules changed, right? And they've now come back. Melbourne had a 1% quarterly reduction in vacancy in just one quarter. lower 1.9% year on year. So a year ago, this was 5.5%, which is well over the average. 3.6 is a little bit over the average, which is usually around 3%. But everywhere else is under the average. And that's a massive difference. And this is how you know there's not risk in the market, because the risk would come from oversupply, which would be demonstrated by vacancy. And these vacancies are extremely low, to the point where you can see in the rent increases, they're getting significant rent increases. So it's got to the point where it says, pay it or move. Now, I think that's quite repulsive. We have always said to our clients, please look after your tenant because they're looking after your asset. You want to be respectful, but the problem is there's the reality check that, mate, that's what you have to pay. And it doesn't matter how good a relationship I've got with a long-term tenant, at some point with interest rates rising, I'm going to be less as friendly as they want me to be. So we are at a very, very critical point in the market. And the only solution to this is more supply. But the problem is it takes a long time to bring on. If you have a look at why I'm thinking that, here is the key statistics to justify the market. You can see here home loan financing fell off the cliff. Okay? That's because people are putting on procrastination button. They're saying no point going getting a loan, interest rates are going up, let's see what happens. So no surprise that financing has come off because they're waiting. But the problem is they're not exiting, they're waiting. And that's the problem. Those 1,000 people that were going to buy last year that didn't, they combine with this year's 1,000 people to have 2,000 people looking for a property. So we've doubled demand because we had a pause last year. It's a cumulative impact. We're not getting rid of these people. They didn't disappear. They've just delayed the decision and they've joined next year's bunch. So this is not surprising that they've done that. Interest rates are a scary thing. But when they wake up and go, oh, I can still afford it and it's still at the low end and I need that property and that property isn't getting any cheaper, the pause comes off and away we go. But the problem here is the supply. And you can see here the approvals has fallen off the cliff. Now, what we would need at a time like now is while people aren't buying, we would need to build more. That's what we should be doing. But we're building less. And that's the problem. We should be supporting construction industries. We should be supporting new acquisition. We should be reducing the cost of new property, but we're not. We're making it just as hard and hoping it solves itself out. It won't. We need quality supply in good areas and no one is doing anything about it. Now, that's bad news if you're looking to buy something you don't already have. It's wonderful news if you already own it. So if you're an investor in a quality property in a quality suburb, hip, hip, hooray. If you're waiting to get in there, step up with courage and go for it. You just need to. If we look at that, people are more wealthy, now, so they can afford these prices. And particularly when we're releasing that cash out of the likes of New South Wales, we're releasing the cash from migrants coming in from Hong Kong, from Russia, from UK, from Singapore, from all over the place, where expats coming back far, far more often with savings of significant sums. And you see, we're more wealthy, we've got more willingness. The house price drop is lack of transaction to me rather than real reduction. But we'll see what the next 12 months. Now I'm going to predict with the housing, I think we're going to have a pretty good year once people figure out that we're still at the lower end of the interest rate historical cycle. Once they realise that there's no supply coming into the market, and when everybody says, I need that property, I need somewhere to live, and my landlord's kicking me out, we're going to have a perfect storm that's going to have another fairly high push to price point. Now, I hope it's not another 15, 20% growth that we had a year or two ago. That's too much in one single period, and hence why we gave some back. But it should be that 5 to 10% growth coming through, which is manageable, affordable, and gives people still the hope and aspiration that they can get their property eventually. So a decent year, 5 to 10%, pretty much across the board, with a lot of capital to be released out of the Sydney market and find its way, particularly to Queensland, particularly into the other markets, coastal, etc. So look for value, look for quality. That's the protection point. Finishing off, we should be optimistic, as crazy as this world is, but by golly, we need to be prepared. So the most important thing is come to work, but bring your life-saving device, because you're likely going to need it. You could be thrown off the ship. If that's around your neck, at least you won't drown. It's a crazy world we live in. It's been crazy for ages. It's likely to get crazier. Every time I think, oh my God, I've seen everything, they find another thing for me to look at. It's just crazy. I don't understand how they know. It's just nuts. But come prepared, because this is different times. It's not how it was. It's not how it's going to be. It's going to be strange and wonderful. But in truth, we're living in an incredible period where, let's face it, we've never had as much excitement, never had as much opportunity, but we've never also had as much risk. So I don't know whether I should be elated or depressed. I can't figure it out. And probably no wonder the whole world is going through some sort of stress, because it varies day to day. But the employment opportunities that we have, the earning capacity that we have, the ability to see things, do things that we never thought we could. You can easily go to Antarctica. That was not possible unless I went on an expedition in the old days. Everything has changed. Embrace it, enjoy it, but try and protect yourself against risk. And risk is in the obvious. Paying too much for something, buying a bad asset. But embrace the opportunity. You can't have one without the other. And that's the thing we have to get used to. If we have just a moment of pause, what happened to COVID? It's like gone. It was the biggest thing for the last 3 years, and now it's not even in the conversation. And this shows our resilience as a species. It's something that allegedly was going to wipe us all out economically and physically, like it never happened. I'm going around the world now. I'm traveling like crazy like I used to. It's like it never happened. There's been a lot of pain and suffering, but people are more worried about interest rates than the scratches and scars they've got from COVID. I'm not sure how that works, but it shows our ability to get off the canvas and keep moving. And you've got to start in this modern world, in my mind, think small for your own sanity, because if you think about everything, bang, it's an explosion in your head. So try and think what matters to you, what's important to you, your family, your accommodation, your career. Think small. Don't think too big too often, because the world is not there to help you with the big picture. You need to focus on yourself and you'll be okay. Stop looking at information that's not real. I beg you, and I've almost done this every year for many years, go check the facts. The statistics that I've put up on these slides, they're readily available. I didn't make them up. They're readily available. But if someone tells you something, just scratch between the surface a bit. Go on to Google, go onto a document, go to a government website, go to somewhere credible and research if something doesn't sound right to you. And believe you me, a lot of things don't sound right in this modern age. So you need to do your own reality checks, your own, for you and your family. So make sure you do it, because if you don't, you're putting yourself at peril, okay? And what you have to try and do is figure out future behaviour. Now, what I've learned is the best way to see that behaviour is take a different look at your children, because they are behaving the future today. Their ability to look at those screens, behave at those, the TikToks and all these things, that's the future. You've got it sitting right in front of you, but you're being annoying rather than, that's educational. If people are going to do that, I better alter my thinking. It's strange what people do now. It makes no sense, but it's the new way. That's the thing. So we need to understand that. And people have more money than they used to. They're spending it differently than they used to. They want more than they used to. And you need to understand that, because if you're waiting for things to happen like they used to, it's a long, long wait. Okay? And please, whatever you do, stay sensible. Sensible is safe. Sensible is normal. You know, a good job, a good salary, a good rent for your tenant, a good house. All these things, you know, are based on sensibility for a reason. Don't get caught up in the hype and the hyperbole. Stay sensible in the safe zone. And don't be afraid to invest in yourself. And by that I mean get a nicer house for yourself. Not the worst one, get a nicer one. Make sure you can afford it. Have a nice holiday. You know, no point giving your money off to all these investment advisors and all this sort of stuff when you've seen with COVID, you might not be around. So invest in yourself. If you invest in yourself, you're going to be happier. And if you're happier, you're more successful. So I think that's the big thing I learned out of COVID, invest in myself. Even my wine policy, it used to be save the best bottle of wine for the right occasion. Now it's drink the best first, just in case I'm not around for the next pandemic. And just the final reminder, quality, quality, quality. Quality of house, quality of company, quality of shares, quality of job, quality of life. That's the thing that protects us. If you buy a good asset, whether it's a house or a share or anything, that's the thing that protects yourself and rewards you most successfully in the future. So look out for that, see how you go. Hope you have a good year coming forward. Hope we have some correctness on our predictions. And we'll see you next year for next year's update. Thanks for your time and attention.